Welcome to Investor Diaries. This is the second of the two-part series on Investment 101. In the first video, we looked at basics of saving, investing, some of the considerations you should have before you start investing, impact of investing regularly or compounding, and eventually some of the robo-advisors that you could consider. Well, in this one, we'll speak about stocks, exchange-traded funds, mutual funds, some of the fees and commissions associated with investing, and finally delve a little into a comparison between should you invest yourself or through a financial advisor. Okay, so let's look at dividends. Dividends is the distribution of some of the company earnings to its shareholders. And it's some sort of a reward that publicly listed companies provide to shareholders for investing in the venture. A question that comes to mind is, are companies mandated to provide dividends to its shareholders? The answer is no. So typically, which are the kind of companies that provide dividends to its shareholders? Historically, if you look at, say, the New York Stock Exchange, you'll see that companies that are more established, have more predictable earnings, they are the ones that provide dividends. A couple of other things related to dividends. So generally, companies provide dividends quarterly, although we do have instances in which we have dividend payouts monthly or yearly, but that is a little less than quarterly. So let's look at some examples of companies that have historically paid out dividends. These would be companies like Coca-Cola, Pepsi, Johnson & Johnson, Royal Bank of Canada, JP Morgan Chase, so on and so forth. Now there's this other category of companies that have never paid out dividends. These would be companies like, say, Facebook, Alphabet, Adobe, DocuSign, Shopify, and the list is endless, so probably add a few more names: Uber, Lyft, Zoom Video, etc. Now let's look at a third category. This would be for companies that used to pay out dividends but are no longer doing so. A big name that comes to my mind is Boeing. It used to be a strong dividend payer, but is no longer paying dividends in light of everything that's happened with the company, the 737 MAX, and other reasons. So the point I'm trying to make here is that payout of dividends, it's not mandatory. But companies, when they take a decision to cut dividends or to eliminate dividends altogether, comes with very, very specific reasons. Now let's look at an example. We'll speak about Johnson & Johnson. Johnson & Johnson is one of the dividend aristocrats in US. It's been paying out dividends since 1963 and has continuously increased dividends every single year. So how does this whole dividend system work? If we look at the chart here, we'll see that Johnson & Johnson last paid out dividend of $1.01. This was a quarterly dividend. If we multiply 1.01 times 4, we'll get the annual dividend of $4.04. Now, to the point of dividends getting increased every single year, let's look at some of the years preceding 2020. In 2019, they paid out dividends of 95 cents, it was 90 cents earlier, and it was 84 cents even prior to that. So this is the meaning of increasing the dividend every single year. Now remember, it's not mandatory for a company to increase their dividend every single year. Now let's take another example. We'll speak about Facebook, because Facebook traditionally is a company that has never paid out dividends. You would see that in all the 8 years that Facebook has traded, it's never paid out dividends to its shareholders. So the bigger question here is, why should you invest in a company that doesn't pay out dividends? The reason is that these companies that don't pay out dividends seek to reward its shareholders through appreciation in the stock price. So the question is, should you invest in growth stocks or dividend stocks? And the answer is, it kind of depends. What's your time horizon? What's your risk appetite? Are you comfortable if the stock price of a company that you've invested in goes down by 20, 30, or even 40%? It's not to say that the price of a dividend stock will not go down, but historically, what's been seen is that growth stocks tend to go higher and lower, so they have kind of more volatility than the dividend stocks. Another question that we've been receiving is, what's the difference between an exchange traded fund ETF or a mutual fund? So let's get the similarity out of the way now. Both of these represent a basket of stocks. And second, because they represent a basket of stocks, traditionally an ETF is less risky than an individual stock. So what are the differences between ETFs and mutual funds? First, it's how they are managed. Typically, mutual funds are run by a professional manager who attempts to beat the market by buying and selling stocks using their individual expertise. This is called active management, and it usually translates into higher cost for investors. ETFs, on the other hand, are usually passively managed funds. So these funds could automatically track a pre-selected index such as the S&P 500 or the Nasdaq 100. There are a few actively managed ETFs as well, which kind of function like mutual funds but have higher fees as a result. Second, their expense ratios. An expense ratio usually indicates how much investors pay every single year as a percentage of the amount invested to own a fund. Passively managed ETFs are usually very inexpensive. So some carry fees as low as 0.03%, meaning that investors pay just 30 cents for every $1,000 that they invest. This is considerably lower than the actively managed funds. So in 2018, the average annual expense ratio of an actively managed fund was like 0.67% compared to an average of 0.15% for passively managed funds like most ETFs. Third is how they are traded. So ETFs usually track an index, but they're traded throughout the day like stocks. So you can buy an ETF and sell an ETF like multiple times a day. On the other hand, if we are speaking of mutual funds, even though they are based on an index, they are priced and traded at the end of each trading day. So you do not have an option to buy or sell a mutual fund during the middle of the day. Now, if you wanted to repeat certain transactions at predefined intervals of time, then in that particular case, a mutual fund would be a better investment for you. For instance, let's take the example of Connor who wants to invest $100 every couple of weeks in his investments. If he were to invest this much money through a mutual fund, he could automate it, which means that money would automatically go out of his checking account to the mutual fund. Specific units of mutual funds totaling to say $100 would be bought and it would start trading. As far as say ETFs are concerned, Connor would have to log into his brokerage account. He would then have to buy those ETFs on his own. So it's just a question of automating whichever you prefer. And remember, this is not to say that there are no exceptions to the rule. There are. For instance, in ETFs as well, we've got some actively managed ETFs. The one that comes to my mind is ARK Investing. In mutual funds as well, you've got some index mutual funds. So you might want to look at Vanguard for their mutual funds, which track specific indices. So also take that into account. So in conclusion, between mutual funds and ETFs, it usually depends on how you want to approach your investment journey. If you're more of a do-it-yourself kind of an investor who likes to take charge over his or her investments, then I would recommend that you should go with exchange-traded funds. And you will be benefited by the fees, by the low fees that ETFs actually charge. However, on the other hand, if you do not have the time to research, you do not have the time to decide which one to buy, which one not to buy, then you are better off going for a mutual fund, because in most of the mutual funds, you would actually come across funds which will have active management. Fees and commission. There seems to be a lot of questions on how much do I have to pay if I'm investing. And that's why what I tried to do was we look at stocks, ETFs and mutual funds separately so that we are clear about how much do we need to spend if we want to start investing. So for stocks, we'll take the example of Apple. Right now it's trading at $120 and let's say you want to buy 10 stocks of Apple. So the amount of money you'll have to pay is $120 per stock times 10, which is 1200, plus the commission fee. And we'll assume for simplicity that the commission fee is a flat $10. So in this case, you'll pay $1,210. This $10 doesn't change. So for instance, if you were to buy, say, 100 stocks of Apple, you'll pay again 120 times 100, which is 12,000 plus $10, so $12,010. Now this works both ways. So you pay to the brokerage while buying and you pay to the brokerage while selling. During this time, let's say you've bought the stock for say 5 years and you want to sell it off after 5. So during this time of 5 years, you typically will not pay anything to the company. Well, if a company is providing you dividends and there is tax implications, that's a separate thing altogether. But typically for holding the stock, you don't pay anything to the company. So this to me is a strong benefit. So, if your goal is for the long term, then you save quite a lot on fees on stocks this way. Now, as far as say exchange traded funds are concerned, one of the key reasons why the ETFs gained in popularity was because of its low fees. Right now, there are ETFs from say Vanguard, which are charging you fees as low as 0.03%. How is this 0.03% calculated? So let's say if you were to invest $10,000 in an S&P 500 index fund at Vanguard, then for that $10,000, you will pay 0.03% of fees for that particular year, which is $3. The caveat to that is that this fees is usually charged every single year. So if you are holding it in the next year, you are going to be paying Vanguard that expense ratio. This particular fees is independent of any commissions that you might have to pay to the brokerage to buy an ETF. Right now, there are several brokerages which have made it free to purchase ETFs. In fact, Robinhood, you can even buy stocks for free. So if there is no commission from the brokerage for buying the ETF, then the only fees that you're paying is to the ETF company. Some of the famous ETF companies that you can think of course, would be Vanguard, it could be BlackRock, and there are others as well. Finally, we come to mutual funds. As far as mutual funds are concerned, there is a fees associated with it, and this fees is usually higher than that of an ETF. So let's say that the expense ratio of a mutual fund is 2%. In that particular case, for every $10,000 that you invest, you'll be paying $200 in fees to the mutual fund company. Another major question that keeps coming up is, should you invest yourself or should it be done through a financial advisor? Now the answer to this as well is, it depends. As far as investing yourself is concerned, you'll need to keep track of the market and you'll need to know basic details about the company as such, because the goal of investing obviously is to make some money, right? So you would want to know something about the company. You wouldn't want to invest in a company and see its stock price going down. On the other hand, as far as say a financial advisor is concerned, you get some professional advice. The financial advisor knows a lot about the market. He or she is doing it for so many of his or her clients. And at this point of time, you are benefited from that person's knowledge. However, that comes at the expense of some fees. So if we were to assume say 2% fees, then remember that 2% fees is something extra that you're going to pay every single year. So if your benefit or if your return was 10% in a year, then that 10% would be knocked down to 8% if it came through a financial advisor. However, there are a lot of people who go to a financial advisor and there's nothing wrong in it. It just depends on how you want to approach your investing journey. In terms of approaching the investment journey, a lot of people even start with say robo-advisors. They get a feel of the market and then they venture into stocks. Some people, in fact, start with exchange traded funds. So they buy a basket of stocks because that's something that they are comfortable with. And then slowly they delve into stocks. There is this other category of people who start with some defensive stocks. So stocks which typically would give out dividends, would give out regular payments. You get used to investing how the market operates, and then you go into stocks which probably can potentially give you longer return, huge returns in the long term. So this is it, folks. I hope you like this two-part series. If you have any thoughts, please let us know by commenting in the section below. And if you like our content, please feel free to like, share, or subscribe. Thank you so much. Till the next one.